It's weird watching yourself on latency. So this is going to be a video class, whatever you want to call it, on Florida first-time homebuyers. What are the benefits? What to keep in mind? What to do? Where to get started? It's going to be very high level, not very in any of the specific program, but really these are going to be the overall guidelines for really any first-time home buyer in using this program. So, a little introduction of myself. My name is Nick Findig. I'm a loan officer here in Florida, Jacksonville Beach to be exact. I've been a loan officer just short of 5 years now, and I couldn't have a better job, career. Mortgages are just awesome in my opinion. And first-time home buyers, there's a lot of, as I tell my clients, there's a lot of mystery when it comes to mortgages. The best thing that you can never do is get education, clarification, and information, but information that's pertinent to you, and knowing what are the pros and cons so that you can not just have a wealth of information, but make a informed and educated decision for your future, right? This is also my first live, so trying to get the nuts and bolts down, but trial and error. And you may not be able to hear me either, so that comes with the territory. I can always redo it. So we're a little early, so I'm going to wait just a second. Sorry for the noise. Okay, so we're going to kick this off. Broader review of down payment assistance. There are what we call in the industry conforming loan programs, meaning they conform to the guidelines set by different agencies, government agencies, I should say. Those are going to be Fannie and Freddie, which I refer to as mom and dad, and those are primarily conventional. And then there's going to be FHA, VA, and USDA. Okay. A down payment assistance program is either a state, county, private fund of some sort to help assist first-time home buyers and acting within the regulations and guides set by these government-sponsored entities with their rules of a party contributing funds. Okay, that's the technical answer, we'll say. Straightforward is you go to apply for conventional loan, whether it's Fannie or Freddie, mom and dad, and then in combination, a down payment assistance program, and then merge the two. Basically what it is in a nutshell. The program I'm referring to in Florida that I most commonly do, and these are not just the only ones available to anybody, but really these are the common ones available across the state, is through eHousing. Now, eHousing it's kind of its own private company or a private state company that offers this financing assistance. With that, the first place to start is getting pre-approved for a mortgage. Okay. There's essentially two parts when getting pre-approved or getting approved in general. Okay. There's approving the individual or individuals, and then there's approving the home. Okay. Getting pre-approved ahead of time is knocking out really half of the loan process up front. Okay. So if you're a first-time home buyer, so you've either never owned a home ever in your history, you've never been on title, you have no ownership to a home, you qualify. In addition, a first-time home buyer may be an individual who's owned a home, but not in the most recent 3 years. Okay, so it's 2021. You haven't owned a home since before 2018, you would qualify as a first-time home buyer. Okay. Now, again, that is say you're not on title. Okay. Title is legal ownership. Where we see this come into play and cause issues, say your parents have added you to title. Should anything happen to them, the home doesn't fall into probate. Technically, you are not a first-time home buyer because you have ownership in a home. You have legal ownership to a home, right? But overall, if you haven't owned a home the past 3 years or ever, you're a first-time home buyer. So getting pre-approved is really about 3 things: credit, income, assets. Okay. It's really not more complicated than that. Credit, income, and assets. Most down payment assistance programs, on average, most down payment assistance programs have a minimum credit score, okay, of 640. Let's dive into that a little bit. 640 you can purchase with less than, but typically most assistance programs have their own minimum set. Again, this is a program that has their own extra requirements that may not be the requirements of the individual government conforming loan. Okay, so typically we see it 640 and 660 in some cases, just depends on the program. Okay, so for example, the program I'm talking about again is e-housing. So you can literally Google e-housing. I'll take you to their website. Their minimum is 640, with the exception of manufactured homes is 680. Okay, but we're going to focus on 640. So for FHA, VA, USDA, and conventional, it's 640. So that's kind of the baseline for credit. Okay, is where your credit score at. Now that's going to be, if there's 2 people on the loan, it's going to always be the lower of the 2 people. So husband and wife. Husband has a, let's say, 650. Wife has a 620. Everything is based off of the lower of the 2 scores. The reason being is the lower score is the riskier score in a scenario. Okay. Now, you could still try and do the loan with just one individual if that was the case. That's more of a specific circumstances. Now, on income. So income is not necessarily tricky. It just depends on a variety of factors. So we're going to take this real slow. If you're an hourly employee, okay, let's say you're an hourly employee, but let me take this a step back. There are rules of how a lender can count income to help someone qualify. In addition to some of these programs, they don't look at just the application income, okay? They look at the household income. So let's break that apart a little bit. If let's say, for example, you're an hourly employee, okay? You're making $30 an hour, okay? But you had overtime and bonuses. The lender may not need to count it or can't count it, say because you haven't had that income long enough to show a true average over typically 24 months. So he's not adding that income to assist with your buying power. Where these down payment assistance programs can get kind of tricky is they'll still count it and they have their own limit, or their own maximum, I should say. So, and again, every county is going to have a different one. Higher income counties, say Miami-Dade, much higher maximum income threshold. Counties, trying to think here in Florida, but let's say just a lower income area will be much lower in comparison. So, and again, household income. Take the example of a husband and wife, okay? Husband's on the loan, wife's not on the loan, but wife works. household income? Does her income exclude you from the program? Okay. That's why getting pre-approved up front is essentially so very important, because you're getting those kind of answers addressed up front before you start going on a contract, before you start paying for inspections and appraisals and all that, to maybe find out that's not going to work. Okay. So you have to be delicate and careful in that. If you're going through one of these programs, and here's the other thing, you do one of these assistance programs, it does not matter the lender that you use. Okay. This isn't his rules are different than my rules sort of scenario. It's going to be clear cut across the board. Basically, who knows their stuff better in that scenario? Who is looking ahead to your in your circumstances into the rules set? And the rules are very black and white. There's not a whole lot of gray. Usually with a normal loan, there's some gray where we can make things work or not work. Most assistance programs are very black and white. So now those income limits, it's also going to be dependent. Is this a conventional loan, an FHA, or what we call government loans, FHA, VA, and USDA, right? So that's also going to depend on where you're at, what qualifies, what's going to give you the most, most buying power, essentially, and the most assistance. Okay. When it comes to income, the general guidelines is, 2-year work history. There's a lot of ways to show 2 years work history without having 2 years. If you're in school actually counts. If you're in the military, if you just graduated, everything like that. Okay. The other thing too is household income is also going to be in consideration of if any children over the age of 18, grandparents, people who are living on a fixed income. That's household income that they're still going to hold. So again, you want to get those questions answered up front in the pre-approval stage before you start putting in offers. Okay. You don't want to think you have an extra $10,000 to assist you and find out it ain't going to happen. So, so credit, income, assets. Now, obviously, assets, you're getting money for these assistance programs to help you purchase. It's a few different ways about it. You can get 3%, 4%, 5%. You can get up to $10,000. There's not just one. So again, that's why I'm kind of talking broadly, is there's not just one size fits all kind of scenario. There's multiple different ones. Okay. And that's a benefit too, if you think about it. Like, does this one program with its rules maybe not work for my scenario and vice versa? And again, you find this all out at the pre-approval stage with your scenario. Okay. So with assets, obviously you're getting money for the down payment. Okay. Why these are beneficial is, a seller, not that we see it that often right now in 2021, but a seller can't contribute closing or concessions, right? So they can't give you money towards your fees or your costs to your down payment, right? Your down payment is considered your minimum contribution. That's your skin in the game. Okay. So, the idea is if it's FHA, which is 3.5% down minimum, okay, at 3.5% is your contribution, whereas the lender's contribution is 96.5%. Okay, so I'm not asking for a lot, but you've got to have some contribution. Those are the same rules for everybody. Okay, and that depends on the program. Now, with other assets, things you need to keep in mind is, one, these programs come with their own fees, right? There's going to be what we call origination costs. So these Florida programs I'm referring to typically come with a 1% or what we call one discount point, but it's basically 1% of the loan amount. Okay. So if it's a $300,000 home, it's going to be $3,000 added to your closing costs. Now, The benefit in this case is you're getting, 3, 4, 5% to cover your down payment. They're only collecting 1% towards closing costs, right? And then some other fees. And again, these are program fees to help continue to fund this pool of money so that more people can buy their first home. There's a lot of benefit in owning a home. I mean, financially, it can help you become so much more well off than a lot of other people, but it comes with that program. So that is something you want to keep in mind. What are going to be the closing program fees on top of the traditional closing costs? These programs, if there's excess funds, it can go towards those closing costs, right? It can go towards the other closing costs, the program fees, but it's not going to cover your everything that you're going to need to bring. Okay. So you need to make sure that you have available funds to close. Now, Florida, a little different than the rest of the country, is one, because we don't have an income tax. One of the ways the state makes their money is through one of the largest expenses is the transfer tax. I've done loans in other states. Right now I'm licensed in Florida and Georgia. I worked for a bank prior, so I did loans. I did a loan in North Dakota, New York. I mean, I've done loans in other states, so I've seen other closing fees. Some of our fees are more expensive in Florida than compared to the rest of the country. Okay, so you need to have in mind, have really about 4% given on negotiations with the closer or the seller, but you need to have about 4% of the purchase price available to close. Okay, just normally. Now, if you're doing an assistance program, you really need to keep in mind 4 to 5%, give or take everything. So keep that in mind. But I see this pitched by either one uneducated new lenders or new realtors who don't understand some of the dynamics of that, because they're not thinking ahead. Really, mortgages are really so much about thinking ahead and planning ahead. There's a lot of money on the line. I mean, you want to have somebody who's planning ahead, and you want to be planning ahead. So, but these programs aren't designed to have you come in and not contribute anything, not have to bring any money to the table. And again, it being in 2021 a seller's market, okay, whereas before, I would have a buyer, they'd use an assistance program, the seller would contribute either a good portion or some closing costs to the buyer. Right now, we're just not seeing it. I've had it in one exception, and it wasn't a great condition. Like, it was actually more of a relief for the seller to get rid of the home. Okay, so they were like, yeah, we'll give you money. So keep that in mind. I mean, start budgeting it out, start working with a lender at the pre-approval stage. Okay, how much can I afford? What's my monthly payment budget? How much money do I need to have set aside, ready to go, even with this assistance program? Okay. Some of the other things, and this is something with this program as well, is if you're under a certain credit score, so if you're under 660 with this credit score, you do have to have what's called 1 month of reserves set aside. Okay, so what is a reserve? What are reserves? After you spend it, so let's say, for example, your monthly payment is, let's just use a number, $1,500. Okay, your monthly payment is $1,500. After you have close, you have your number, right? Again, just pulling numbers out of the air. Let's say your cash to close is $5,000. You need to be able to show another $1,500 in your bank account after you close. Basically, you have a safety net, a 1 month safety net in your bank account after you close. Okay. A mortgage is calibrated on risk. Okay. Lower credit scores are viewed as higher risk. That's why there's a minimum credit score for these programs. Is there's a risk. There's a what is this person's credit score is a reflection of their payment history on time. Okay, they have a bad payment history, might not be a good candidate to pay us back hundreds of thousands of dollars, right? Sorry, we did see that at one point in time. There was this idea and perception is who doesn't pay their mortgage? Well, comes to find out, a lot of people couldn't afford a mortgage. And I'm not saying there weren't bad mortgages, but there was a misunderstanding of how, you needed to pay stuff back and pay it back on time. Okay. You don't have to have, and side note, I'm going to rabbit trail very briefly. You don't have to have a lot of debt to have good credit. They are not synonymous. Okay. They're not synonyms, whatever you want to say. Good credit is primarily based on two factors. Okay. There's 5 overall factors. The 2 biggest factors that make up a credit score is 1, payment history. It's about 35% of your credit score. Okay. And 2 is amounts owed, right? How much overall debt do you have? Okay. Different types of debt are treated differently. Car loans are treated differently than, say, credit cards. Okay. Not overutilizing credit, not overextending yourself. Okay. And paying your stuff on time or even slightly early are going to take up 65% of your credit score. The others are real easy. How long you've had credit. Okay. So you never want to close credit cards. You never want to, paying off car loans. That's different. Closing credit cards, never do. Okay. That's history. Don't delete that history from yours. If they close it, it's one thing, but never intentionally close your credit cards. Okay. If you're a Dave Ramsey person, he's wrong. Sorry. Not sorry. So not overusing credit, not opening a bunch of credit, opening up credit every now and then, that's one thing, but constantly opening up credit, that can hurt you. I don't know if anybody's watching this either right now. Sorry. Okay. One of the other factors, another thing that we have to keep in mind when helping someone qualify for down payment assistance and really down qualifying for any type of mortgage, right, is what we call debt to income. Okay. Think of debt to income. You may have heard it, seen it, whatever it is, but think of debt to income as maximum capacity. Okay. You have 2 percentages when it comes to debt to income. First percentage is household debt. Okay. Think of your monthly payments. Okay. So your credit card payment, not your overall debt, not the whole pie, but the payment of the pie. Okay. So say, for example, that minimum payment is $25. What's your minimum car payment? So that's your household debt of anybody who's on the mortgage. Okay. Then that's your front end debt to income. And then your back end is household plus expected mortgage payment, right? These, again, you have to they're more conservative, they're less risk. There are programs that'll go higher, okay? But again, if you want to get this program, it's their rules, okay? They have a pretty hard and fast rule of what we call 45%. The easiest way to calculate it, take your monthly payments, okay? And you've got your gross income, so before taxes, insurance, and all of that jazz, okay? So your gross income, and then, how much money comes in, how much goes out, and how much more can you afford, okay? Everyone's a little different, right? So it's always based on your particulars. Now, there are contingencies to allow for higher debt to income. The reality is there are certain things that we have to kind of run. There are systems that we have to run. We call them AUS, and it stands for Automated Underwriting System. Okay. And they kind of give us a green light, yellow light, red light. Can't do it. Red light is just not going to happen. Yellow light, okay, let's try and tweak some things, but we're trying to get a green light. Green light is, yep, based on this criteria, you're good to go. And that's what an underwriter is going to work from for approval of the loan. So they may say, yes, you can have a debt to income up to 50%. The reality is it's very hard to get that type of approval, okay? So you really want to try and focus on staying under 45% in combination with your current monthly obligations, as well as your expected credit or expected mortgage payment. Okay. Best advice as well for first-time homebuyers is focus on payment. Okay, so really focus on what your rent is now, right? The rent you're most comfortable with, the mortgage payment. The goal is it's either going to be about the same. Everybody wants it to be less. Who doesn't? But about the same. The reality you need to keep in mind is with purchasing a home, it is, as I say, it's an investment. Okay. You do have to put some money in, but over time, you'll start to get that return. Okay. If your mortgage payment now is about the same to what your rent's going to be, keep in mind a couple of things. Is the home going to be bigger? Okay. Is it a home rather than an apartment? Or is there more square footage, more rooms, all that kind of stuff, right? Those are other benefits of owning, okay? The other side thing to keep in mind too is when you purchase a home, you're really locking that monthly payment in, okay? Things that'll adjust over time, property taxes. You have what's called a homestead exemption, so it slows down property taxes from rising year over year. And then home insurance, okay? You have to maintain the home, you have to update the home, roofs, the important things like that. But over time, and again, dramatically over time, that's what a lot of people have noticed here in the past few years, is in comparison to how quickly rent goes up versus your monthly payment becomes no comparison. So I'll give you an example of my home. Again, I used down payment assistance to purchase my first home. It was a little $90,000 townhouse, and it was all I could afford. No shame in that. And the monthly payment right now, it's gone up because of insurance. But the monthly payment right now is about $800 a month. And the average rent I'm seeing in the exact same community is, I think the last one I saw was like $1,200. But somebody, so $1,400. Okay. It's not going to be my forever home. It got me started. But again, in comparison, I'm saving a bunch of money in comparison to where if I hadn't bought sooner rather than later. That's why down payment assistance and buying a home sooner than later is so important, because you are protecting yourself from future costs or future expense of living in comparison. Right now, a lot of people are experiencing dramatic rises in their rent, so buying is always important. So we've gone over kind of baseline again, the big three. Let's talk about the property. Okay, with this program, single family homes, townhomes, really okay. I tell people the baseline thing is it's safe and habitable. Is there flooring? There's no holes in the walls? There's no holes in the roof. I've seen a lot of that. Safe and habitable, moving, doesn't have to be perfect or updated. That's your preference, but for approval, safe and habitable. You can now, with this program, purchase a manufactured home. It's a little different. One, credit score minimum is 680. Okay. But you now can buy a manufactured home. Quick high points on a manufactured home. One, needs to be a double wide. 2 needs to be built after 1976. Okay. And 3 has to be permanently affixed to a foundation. It can't be literally mobile. It can't be on wheels. You can't, I mean, basically, no one should be able to come up, hitch it, and take off with it. Okay. You also can't do any kind of conversion to make it permanent, right? Now, in Florida, it's very popular is condos. Condos are kind of a different thing. Okay. I could do a whole multiple videos on condos. Okay. Let me give you the highlights. Okay. Condos, it's, as I said, you're approving the individual and then you're approving the home. With a condo, the exception to all the other types of homes is you're not buying the dirt underneath it, you're buying the inside of 4 walls. So what has to be approved is not just that the home is safe and habitable, is that the community is actually healthy. Okay, there again, you go back to the beginning of the video, those government-sponsored entities. Okay, they have their own parameters of what constitutes a standard of acceptable condos. Okay, some of the highlights that the investor doesn't own more than a majority stake in it. So I want to say doesn't own more than 60%. I'd have to go back to the guidelines on that to make sure. But basically, other people own enough and are contributing to the HOA, community fees, and everything like that to maintain the property. 2 has a insurance policy of $1 million. Okay, and it's not a condo tell. Basically, it's not an investor type of thing. The idea in that sense is, what happens if nobody, if only investors own it, then what happens if nobody lives in it? It's not a primary home, right? The reason being is in Florida, right after the crash, a lot of people had condos. They were either their second homes, investment properties, all that. So what was the first home they foreclosed on? Their condos. Okay, and their second homes and things like that. So and again, I can do a whole nother video on condos. I'm not going to spend a bunch of time talking about them in this video. So but yeah, that really covers it. The assistance programs, again, as I said, it's 3%, 4%, 5%. And that's also, I'm sorry, I should have made note of this. That's based on the loan amount. Okay, it's a little different than the purchase price, but it's not that different. So, and then in addition, they have another two, up to $7,500 a month, up to $10,000 a month. Now the $10,000 program, and they've made a few adjustments to it, but sorry. One of the things you should always ask when you're looking at a down payment assistance program, I don't care what type of program, okay, whose program, whatever, is, do I have to pay it back, and when do I have to pay it back, right? What are the terms of paying it back? So give me an example. One of the programs is forgiven after 5 years. So every year, 20% of the amount borrowed or amount taken is forgiven. And after 5 years, it's fully forgiven. Sell the home, refinance, whatever, don't have to pay it back. Some of the other programs, no matter if you live in it for 30 years, sell it after whatever years, or refinance it, you have to pay it back. Okay. One of the programs does have an additional monthly fee, comes to about like $69.02 a month, and it's forgiven after it's paid off after 15 years. So if you sell it before then, you have to pay back whatever is owed. Okay. So, but again, any assistance program, it doesn't matter whose program it is, make sure you always get that clarification. Okay. You don't want to sell a home or refinance your home down the road and then realize you're on the hook for several thousands of dollars. Okay. And again, some may be forgiven after a period of time. Just needs to know which one you're going with, right? So you can make your proper choices. What else? Sorry. Also don't see any questions, so just going to keep running with it. Just checking. So I think that really covers everything. Again, everybody's situation is going to be slightly different, right? One person's pre-approval, one person's loan option is going to be different from another. It's very important to talk to a loan officer, right? Someone who's local. Most call center types, and this isn't, I'm not trying to pick on anybody, but companies like Rocket Mortgage, they're just not familiar with these programs. They have, it's additional work, the guidelines, needing to know extra additional things. People who are more local to the area or, kind of more boots on the ground and work in one state, not nationwide necessarily. Like, I can't tell you anything about down payment assistance programs in Georgia. Even though I'm licensed in Georgia, I've never had exposure and experience in it. This one, the bank I worked at, we did a lot of them, so I'm very familiar with them, done them. I'm very familiar with it. Yeah, I need to go double check a few things every now and then, but hasn't changed too much. So, but yeah, you want to focus on working with someone who's local with this program, who's in the area and things like that. Yeah, actually, so someone is watching. That's cool. No, in Miami-Dade, so the programs I'm talking about, they do have a couple of specific Miami-Dade ones, but the ones that I've kind of gone over broadly, they'll apply to. So there's not much more, not a big difference really. So anything specific about Miami-Dade you're wondering, or just like, does it cover Miami-Dade? So also in Miami-Dade, the household income limit, and I will double check for you, is 91,400 for a 1 to 2 person household. Yes, it just does cover Miami-Dade as well. Yeah, so like statewide. Okay, so think of the whole state. Again, there's specific. I think there's specific county ones, but they're very similar to like the overall state ones too. So, yeah. One of the other things too to keep in mind, this being a state program, so the state program is, so my company, I work for Loan Depot here in Florida. Say another company like who's Movement Mortgage, Wells Fargo, and it's not isolated to one lender to do these programs. Okay, a lot of lenders are kind of approved to do these loans. With that being in mind too, now I will say some do it well, others don't. But with that in mind, the lender who's doing a loan doesn't set like the interest rate. Okay, it's actually the program itself who's setting the interest rate. Okay, so don't think you can shop it, you'll get a better rate somewhere else than comparison. One other thing I've never quite seen, I'm not saying it doesn't exist, but let's say for example, I know the requirements of what documentation you're going to need for a pre-approval, but whereas maybe some other companies, so the program has its own, like, hey, we have to see this stuff. Some institutions may have extra things, so you want to make sure you're working with, again, someone more boots on the ground, familiar with the program and things like that, because again, their own company may have extra restrictions. I've seen companies actually add their own extra minimum credit scores, whereas the program's credit score is 640 basically overall. So again, keeping in mind. So again, yeah, broad strokes overview of the Florida program. Yeah, absolutely. No, thanks for watching. And if you have any questions, feel free to reach out. Especially if it's more specific to your situation. Again, this is a broad view over strokes, but your situation is going to be very different than anybody else's. So any specific questions that you need answered for yourself, please feel free to reach out. You know, my website, all my contact information is on, you know, on my channel. So, but yeah, unless the one person watching has a question, I'm going to end the broadcast. All right. So, all right. Well, have a great night. Thanks for watching us here on Tuesday and take care.